Guys, what's up? Thanks for checking into the channel today. Happy 4th of July. I stepped away and had a thought about if I was actually in the market to get a loan today, what would that process look like? And I wanted to share it with you guys. I'm going to actually go through the full spectrum of what it takes to get a loan. So grab a pen and paper. It's going to be a lot of really great information. So let's dive right into it. There are multiple ways for you to get qualified for a loan, obviously depending on the type of income and industry that you're in. But what I do recommend is prior to starting to shop for any type of a home, you should get pre-qualified. When you have a conversation with somebody about what your finances look like, potentially what your expenses are, that is more of a pre-qualification process, because if I was sitting with you and you told me you make X amount of money and your liabilities are X amount every single month, based on the amount of money that you have for a down payment, I could tell you that likely the amount of money that you're going to be able to afford, or the type of loan you'd be able to afford, max dollar amount, would be X. However, I wouldn't be able to validate these things unless I actually look through your documentation. And when I say documentation, I specifically mean one, getting an authorization to run your credit, because a lot of times when we run the credit, there may be some surprises and things that people weren't aware of that would be considered a liability, and they come off the top. Okay, so starting from the beginning, it's a conversation, and then you kind of give a framework as to what your income is, what your liabilities are. I would give you an idea approximately of how much dollars you'd be able to afford, which that's a conversation that goes back to somebody who's showing you homes, right? So if you have a real estate agent that you're working with and they want to know approximately how much house you can afford, tie that in together with your down payment. Now we have a general idea. It doesn't hold up your process. It allows you to not necessarily look for things that are too expensive that you may or may not think you can afford. This way you're not wasting your time. Now, as we move forward, let's discuss that. Next step is you completing a loan application. The loan application basically goes through your personal information, which is just your name, your address, whether you're renting or you currently own something. And then it goes into your employment, the amount of money you make. After that, it trickles into your assets, your liquid assets, how much money you have, whether it's in checking, savings, retirement accounts, stocks, that sort of thing. Okay, and then there is a general list of questions that takes you back 7 years in terms of credit. Did you file for bankruptcy? Anything of that nature, which would be considered a derogatory, is addressed through your loan application. At the same time, you sign an authorization for the lender or the broker to pull a copy of your credit report. Now I'm going to get a little bit more in detail about this part. If you're married, then what we technically do is we pull credit for both spouses, a merged credit report. It's a joint credit report. And the lender, whomever we submit the loan to, is going to use the lesser of the two mid scores. So let's use an example. Me and my wife apply for a loan. My credit score is 700. Her credit score is 680. The lender mid score. The lender is going to use the lower of the two, which is the 680, to qualify. Now, when I say to qualify, pricing is going to be based on the lower credit score. So we have the application now. We ran your merged credit report if you're married. If you're not married, of course, it's just you. If you have a fiance, you're still not married, then, and if we need both of the incomes to qualify, then there would be two credit reports. However, this is a little bit more technical but since we're discussing it, when you're married, you and your spouse are in one application as a borrower and a co-borrower. When you're not married, or you have a co-borrower who is related to you, but again, not married to you, again, there's two credit reports, and it's a standalone application behind another standalone application. Now, I'm gonna dive in a little bit deeper now. So we have your loan application, and we run your credit. Your liabilities, assume you and a spouse, are gonna go directly into the loan application. And we're gonna see all your liabilities. When I say your liabilities, we're gonna see everything you owe, but we're only concerned with your monthly liability, because at the end of the day, your mortgage, whatever it is you borrow, you're not paying that off, immediately. It's gonna be a monthly liability, just like everything else on your credit report. So for that purpose, all we're really concerned about is whatever it is you make monthly in terms of income, and then whatever your monthly liabilities are, or proposed meaning that you don't have that mortgage liability just yet, but when you will have it, it needs to be offset against your income. Now, I'm gonna say this to you. In most cases, or a lot of cases, we don't necessarily have to use both people's income to qualify, especially when it's a married couple. A lot of times what happens is there's a lot more income coming from one spouse than the other. That's pretty common. So what we end up doing in those situations is we simply use the income from the spouse who generates most of the income, and then both husband and wife are entitled together. Okay, so just because you're not a part of the loan application, that has nothing to do with you being untitled. You could still be untitled. So hopefully that makes sense. That's kind of like a really big point. Moving forward, everything that's listed on the loan application needs to be supported with documentation. So as an example, if you say you make X amount of money on the loan application, then we need to support that income depending on whether you're self-employed or you work in a company with either a W-2 and a pay stub or 2 years tax return. It's different for people who are self-employed. Typically that income is average over a 2-year period. You do have to be in business. The business needs to be in business. When I say in business, you might be doing something for 10 years, but then you opened the business 1 year ago. That doesn't work. Self-employed individual needs to be in business in that particular business that they opened for 2 years. So we match up your income to whatever is written in the application, whether it's just you or you together with somebody else, whether it's a spouse or not, it doesn't matter. Then we have to line up your assets, meaning whatever we wrote in there needs to line up. Now, say you're trying to buy a primary residence and you need, let's just say $100,000, but you only have $50,000. Then what we have to note in the application is where the other $50,000 is coming from. Now, sorry. When you're applying for an owner-occupied property, it's okay to have gift funds. It's no problem. And typically, what I would highly suggest is don't start transferring money around. That's a really big mistake, because everything you do needs to be documented and sourced. Meaning, say you're a person who makes $100,000 a year, and say that you need $50,000 for a down payment, and you have 30. So $20,000 is wired into an account. We know it didn't come from your work, so we need to know where it came from, meaning it needs to be sourced. Here is the solution. If you're going to use gift funds to qualify, make sure they're sent directly to escrow. It's a single wire and it could be sourced. It's just less paperwork, speeds up the process, and nobody needs to wire money directly into your account. The lender, whomever we use, is simply going to give a gift letter. We fill it out and we submit it to the underwriter. Let's keep going. So now we have your documentation, it lines up with your application, and we have your credit. What comes next? We take a look at the ratios. We have to make sure that the qualifying ratios that basically we could use up to, and this is the max, up to 50% of your income before tax to qualify you for housing and all your expense. Now, when I say housing, I mean the principal, interest, taxes, insurance, plus anything else that's being reported on your credit report. Now, sorry. There are things that are not included in that, like, healthcare, childcare, those, they're not on your credit report. We don't worry about those things. Assuming the aggregate is less than 50% of your monthly income, then we're good. We take the file and we submit it into the lender, whomever we use, right? Because we're a wholesale broker. So depending on the type of product that you need is where we're gonna place the loan. Obviously, depending on how quickly we need to move, depending on pricing. However, let me share this with you. If you're getting a loan across the board, speaking to America in general, of 970, 800, we're in 2022. And the reason I say that is because that's the conforming high balance limit. What does that mean? You see, these loans that are submitted to all the lenders in America, up to 970, 800 typically are sold to Fannie and Freddie Mac, and the guidelines are national, which means that no matter which lender I use, retail or wholesale, meaning whether it's a bank that you walk into or a wholesale lender that submits to not a bank but just a wholesale lender that only funds mortgages, at the end of the day, they're gonna have a checkbox for Fannie and Freddie Mac to buy those mortgages once they fund the loan. So they're gonna be the same. Guidelines are gonna be the same. Qualifying ratios are gonna be the same. Everything across the board should be the same. Now, there is a group of loans called portfolios. We're not gonna talk about that, where the lender themselves decides how they fund it, and they make similar guidelines to Fannie and Freddie, but there's some changes. We're not gonna get into that. I just want you to know that if the loan is being sold to Fannie and Freddie Mac, it's a conventional loan and it follows conventional guidelines. Across the US, the guidelines are the same. Now, that loan gets submitted to the lender. The lender now issues electronic disclosures to you, the borrower. I get this question asked a lot, and I wish people were more informed, specifically people working in the field of real estate. I don't want to say anything to knock anyone's expertise whatsoever, but this is something very important that a lot of people don't know or often overlook, is the fact that a lender cannot order a third-party report like an appraisal, because I'm constantly being asked by real estate agents, when are you going to order my appraisal for the borrower, okay? And the answer is, as soon as the loan is registered with the lender and the disclosures go out, specifically the lender's estimate, which tells you the breakdown of all the fees, and the intent to proceed, which is your acknowledgement that you want to move forward. Now let me throw this out there to you. No matter what you sign through that process or acknowledge, until you sign your loan documents with a notary, you haven't technically bound yourself to anything. So it's really more of a compliance wheel that you're turning, so the lender can always say, hey, I disclosed all these things to the borrower, and as they changed in the transaction, and we'll talk about that, I continually disclose the changes. Now, what could possibly change? Well, when you disclose a loan, you don't necessarily have to lock the rate. You may or may not. It really depends on the market. So once you do lock the rate, the borrower is going to get an updated lender's estimate showing now your rate is locked, which may or may not be the same as when the loan was disclosed. Okay, now mind you, I'm going to give you this piece of information. Locking a loan for 15 days, 30 days, 45 and 60 days, completely different pricing. So you might say, well, you know, the market's going to change and we don't really know what's going to happen in this transaction. Just lock it for 60 days. That's fine. It may or may not be in your favor. If we can close a loan in 30 days, pricing is going to be different. You're going to pay more. However, if you know you're in a moving market and you're not sure what's going to happen, it might be smart to lock it for 60 days, because if you don't and you get to 30 and now rates expiring, rate lock extensions are a lot more expensive. So just something to keep in mind. Right now, once the disclosures go out, borrower acknowledges the disclosures, specifically lender estimate and intent to proceed. There's a stack of others, but those are the main ones. Now we can order the third-party reports. Going back to the real estate agents, oftentimes I'm asked, why is the loan not registered? If we don't have all the pieces to the puzzle, if you submit a loan to the lender, or you think you're going to submit a loan to the lender without all the pieces to the puzzle, the loan is going to get suspended, meaning the lender is going to put a stop sign and say, hey, until we have all these pieces in the file, this loan is not moving forward. And that's stopped at the setup team, which is the first line of defense once you submit your loan, technically. So it does you no good. You want to have all the pieces to the puzzle, so you submit it, it goes through setup, and then as soon as it does, the loan gets disclosed that we just discussed. Once it's acknowledged, then next step is to load all the documents into the portal for the lender to push the file into underwriting. Okay? Now, files in underwriting, typically that takes, several days for the loan to be reviewed by an underwriter, who's simply a person who's going to review the work that you have done to check off the boxes and say, you know what? Yep, this file actually qualifies based on everything submitted to us. We are going to conditionally approve this file subject to these conditions. Give us these conditions and we will give you a full commitment that we will fund your loan. Now, typically speaking, even if you submitted everything to the lender, there's always going to be some kind of a condition, because a lot of the conditions, even if you've done a wonderful job in submission, are going to be for third party, like escrow, title, insurance. Remember, you're buying a property from somebody who's going to have a clear chain of title. What does that mean? You want to make sure that, not you, but the title company wants to make sure that the title hasn't been switched from one name to the other without being insured. If you're using a non-insured instrument, like a deed of trust, like a quitclaim deed, then I could transfer title from my name to another person simply by recording a document. We can get more into that, but I want in this particular video, all I'm trying to say is that there's a lot of things that come from the other side, depending on whether it's a purchase or a refinance. Okay, it could be payoffs if it's a refinance, preliminary title report, escrow instruction, executed agreements, a bunch of different things. So all these things need to be cleared with the lender before they will go ahead and sign off. Once all the conditions have actually been met, you will get something called a CTC. It's a clear to close. Now your file is ready to be moved out of underwriting and into closing. That's assuming all the documents are there. If the documents and the income doesn't line up, the lender can also deny the file. If it doesn't line up to the guidelines for any reason, as an example, say this is a cash out and you haven't been on title for 6 months. Whether you have all the other pieces of the puzzle doesn't matter, because the guidelines say you got to be on title for 6 months to be able to cash out of a property. There's caveats to that. I'm not going to get into that in this video as well. However, just giving you a framework of things that need to happen, and they have to line up. Once all the conditions are signed up, we're now clear to close. This is great. File goes from this department to the closing department. A closer is now assigned to the file, which means we can generate loan docs. But before we do, we have to balance your file. Balance your file with the escrow company. So typically speaking, you will get a closing disclosure. Just like you got a lender's estimate, you'll get a closing disclosure to acknowledge. From the time you acknowledge your closing disclosure, 3 days must pass before you can sign your loan documents. This is just compliance, okay? So you gotta make sure there's certain things in the transaction that's gotta get checked off. One of them is your appraisal. The other one's your insurance, okay? Basic things that have to trigger the CD. The CD is released, you acknowledge the CD, 3 days later we can go to docs, okay? Now we got a closer, we got the escrow officer, they're balancing the file to make sure that they both agree on the figures that are part of the charges in your particular transaction. Once they do, and they balance, the lender will issue the loan documents for you to sign. Now, depending on whether this is a purchase or an owner-occupied refinance, if this is a refinance, owner-occupied, and they sign it, there's a 3-day rescission to fund. If this is a purchase, you can fund potentially the following day, okay? It all really depends on when the executed purchase agreement says that now it's time to close the transaction. A factor in that is going to be the prorated interest, because if you're closing towards the end of the month, this is the amount of interest that you pay, the interest that you pay to own the property. So as an example, if I close on the 25th, I pay 5 days, assuming there's 30 days in the month. I pay 5 days of prorated interest to close the transaction. My next payment is not due until the following month because mortgage is paid in the arrears. Let's use an example. Right now is July 4th. Happy 4th of July. If we close the transaction today, right? I assume there's 30 or 31 days in this month. I'm not 100% sure. So we would actually have to pay interest through the end of the month. Let's say there's 30 days, so 4th to the 30th is 26 days worth of interest. The next payment is not going to be until September because mortgage is paid in the arrears. So we would actually pay August payment in September, okay? So you would actually pay a lot of interest if you closed early in the month. If you close late in the month, say it was like the 25th or the 26th, we would only have 4 or 5 days of interest to pay for, to close the transaction. This is all a part of the balancing. This is the example that I'm giving to you, okay? You sign your loan docs. Something that's very important to know when you do sign your loan documents is that the notary is gonna leave with you. Now, you could actually go to escrow, depending on where you are, to signing appointment, all your loan documents, because you do have to notarize, and you have to show up with your ID. Once you sign your documents, depending on whether there's a grace period to close or not, as we mentioned, purchase, you can close the following day, even the same day, and then refinance as an owner, there's a 3-day grace, and then you fund. And you could do it either with a traveling notary who can come to you. Typically, there's a couple $100 charge, or you just show up at the escrow company. It's usually about $100 and whatever, $25, $150 less. Kind of up to you how you handle that piece. Balance to close with zero money, or you may request to not balance and stay on a certain schedule. As an example, say that you owed X amount of money and you want to continue to owe X amount of money and the transaction costs, X amount of money. You may want to keep your old balance, which means you have to bring money to close. Same thing on a purchase. You're going to need to bring money to close. So before the transaction can actually record, not fund, but record, you have to wire in the money that is required of you. So let's use an example. You're doing a purchase, 20% down payment. You signed all your loan documents. Your notary or your escrow officer is going to leave you with a wiring instruction sheet, which I highly recommend to call in because there's a lot of wire fraud, just to go over the account numbers and the routing number to where this money is going. However, it is safer if you're getting it in person. So now, the closing estimate is going to show the amount of money that you need to wire in. Your transaction will fund by the lender, whether that money is in or not. However, the following day, I'm in LA County, records the following day, which means that the title company needs to verify that the money has actually been received to be able to record your transaction. Otherwise, you can't close. Did you catch that? So you're going to loan docs, you're signing your loan documents, 20% down payment, whatever it is you're bringing in. You got to wire that money in with the wiring instruction that are given to you by either the escrow officer or the notary to make sure that that loan can record after it's funded. Once a loan is recorded through the title company at the local office of, county recorder, the property now is in your name. You are the new owner of the property. So I've given you guys the journey as it goes from loan application to submission, underwriting, clear to close, to closing, then funding, then recording. If you have any questions, it's a lot of information. If you have any questions, please put them in the comments below. I'll be happy to answer them. Otherwise, I do appreciate you guys watching. Thank you. Happy 4th of July. As always, if you enjoy the video, please give it a big thumbs up. Subscribe to my channel if you haven't done so already, and I will catch you on the next video. Thank you for watching.